Something unusual is happening in the silver market right now. And I'm not talking about price movements or speculative trends. I'm talking about physical metal, the actual bars, coins, and industrial-grade silver that businesses and investors depend on, quietly vanishing from warehouses, vaults, and retail channels faster than most people realize. If you've tried to purchase silver recently, you may have noticed longer wait times, higher premiums above spot price, allocation limits from dealers who previously had ample inventory. These aren't isolated incidents. They're symptoms of a structural shift that's been building for years and is now accelerating in ways that deserve your serious attention. Today, we're going to examine what's actually happening beneath the surface of the silver market. We'll look at the forces driving this physical shortage, what it means for the broader financial system, and most importantly, how you can position yourself intelligently regardless of whether you currently hold silver or you're considering your first purchase. This isn't about predicting tomorrow's price or chasing the next rally. This is about understanding a fundamental imbalance between supply and demand that has profound implications for anyone interested in preserving wealth, hedging against systemic risk, or simply making informed decisions in an increasingly uncertain economic environment. So let's begin with the facts. When we talk about silver disappearing, we need to be precise about what we mean. Silver trades in two distinct but interconnected markets. There's the paper market, where futures contracts, exchange-traded funds, and derivatives represent claims on silver without necessarily involving physical delivery. And there's the physical market, where actual metal changes hands, gets shipped, stored, and used. The price you see quoted on financial networks is primarily determined by the paper market, but the price you actually pay when buying coins or bars includes a premium above that spot price. That premium reflects the real-world costs of fabrication, distribution, dealer markup, and most importantly, the balance between physical supply and demand. And right now, that premium is telling us something critical. Over the past several years, premiums on popular silver products have expanded significantly. What used to be a 2 to 3% markup over spot has, in many cases, doubled or tripled. During periods of acute shortage, premiums have spiked even higher. This divergence between paper price and physical availability reveals a fundamental tension in the market. Let's talk about where silver comes from. Unlike gold, which is primarily mined for its own sake, roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply doesn't respond quickly to silver demand. Even if silver prices rise substantially, mining companies can't simply decide to produce more silver. Production is largely determined by the economics of base metal mining. Primary silver mines do exist, but they represent a minority of global output, and bringing new mines online takes years of exploration, permitting, development, and capital investment. Meanwhile, existing mines are facing rising costs, energy expenses, labor costs, regulatory requirements, and the declining ore grades of mature deposits all pressure profit margins. Some marginal producers have reduced output or suspended operations entirely when economics don't justify continued extraction. Then there's recycling, the recovery of silver from industrial scrap, photography waste, jewelry, and old electronics. This secondary supply has been shrinking for years as photographic film usage has declined and electronic devices have become increasingly difficult to recycle economically. Add it all together, and you have a supply profile that's relatively inflexible and unable to rapidly respond to surging demand. Now let's examine the other side of the equation. Industrial demand for silver has been climbing steadily, driven by applications that are genuinely difficult to substitute. Solar panels require silver paste for electrical conductivity. Electric vehicles use significantly more silver than traditional cars due to their electrical systems and components. Electronics, medical devices, water purification, and countless other technologies rely on silver's unique properties. This industrial consumption is largely price inelastic. Manufacturers need silver to produce their goods. A company building solar panels can't simply decide to use less silver because the price increased. The technology requires what it requires. Investment demand adds another layer. When economic uncertainty rises, when inflation concerns mount, when trust in financial institutions wavers, investors historically turn to tangible assets. Silver, along with gold, has served this role for thousands of years. But here's where things get interesting. The amount of above-ground silver available for investment is surprisingly small. Most silver ever mined has been consumed in industrial applications and is now dispersed in landfills, obsolete electronics, and other forms that make recovery uneconomical. The total amount of silver held in all known exchange-traded products, major vaults, and government stockpiles is measured in hundreds of millions of ounces. That sounds like a lot until you compare it to annual global demand, which exceeds 1 billion ounces. For several consecutive years now, global silver demand has exceeded newly mined supply plus recycling. This deficit has been met by drawing down existing inventories, the accumulated stocks held in warehouses, vaults, and strategic reserves. Think of it like a reservoir. If more water is being drawn out than is flowing in, the water level drops. Eventually, you reach a critical threshold. We're watching that threshold approach in real time. Reported inventories at major exchanges have declined. COMEX warehouse stocks have fallen substantially from their peaks. The Silver Institute and other industry groups have documented persistent deficits between supply and demand. Some of this inventory drawdown has been gradual and orderly, but during periods of heightened buying, whether from industrial users securing future supply or investors seeking portfolio protection, the drawdown accelerates noticeably. Dealers report difficulty sourcing product. Mints struggle to keep up with demand. Delivery times extend. Premiums rise. These are the visible symptoms of a market under stress. There's another factor we need to address honestly, the structure of the silver market itself. The paper market for silver is enormous relative to physical availability. Futures contracts and derivatives represent claims on many times more silver than actually exists in immediately deliverable form. This structure works fine under normal conditions. Most futures contracts are settled financially rather than through physical delivery. The system relies on the assumption that only a small percentage of contract holders will ever demand actual metal. But what happens when that assumption breaks down? What happens when industrial users concerned about supply chains decide to take physical delivery? When investors, skeptical of financial instruments, demand real metal instead of paper claims? The market structure begins to reveal its fragility. We've seen brief moments of stress before, periods when delivery demands exceeded expectations and caused temporary dislocations. These episodes were resolved, but they offered glimpses of what a more sustained delivery squeeze might look like. This isn't the first time silver has experienced supply-demand imbalances. In the late 1970s, the Hunt brothers attempted to corner the silver market, driving prices to unprecedented levels before the bubble collapsed. That episode revealed how concentrated buying could overwhelm available supply. In 2011, silver spiked dramatically amid post-financial crisis monetary expansion and investor concern. Premiums exploded, and physical product became scarce. The subsequent correction was equally dramatic. What's different about the current situation is its foundation in fundamental industrial demand rather than purely speculative activity. The solar industry alone is projected to consume increasing amounts of silver annually for the foreseeable future, as renewable energy deployment accelerates globally. Electric vehicle production is ramping up across major manufacturers. These aren't speculative bubbles, they're structural shifts in how the global economy functions. When you layer investment demand on top of this growing industrial baseline, the supply-demand picture becomes increasingly precarious. Zoom out further, and we need to consider the broader economic environment driving behavior in precious metals markets. Central banks around the world have engaged in unprecedented monetary expansion over the past 15 years. Balance sheets have grown to historic levels. Interest rates, until recently, were held at or near zero for extended periods. When traditional savings vehicles offer minimal returns and the purchasing power of currency is eroding through inflation, tangible assets become increasingly attractive. Silver offers a unique position in this landscape. It's cheaper per ounce than gold, making it more accessible to average investors. It has industrial utility that provides fundamental demand support, and it maintains the monetary characteristics that have made precious metals valuable throughout human history. The growing awareness of potential systemic risks, from banking sector stability to currency debasement to supply chain vulnerabilities, motivates individuals and institutions to hold physical assets as insurance. This isn't paranoia, it's prudent risk management. Can anyone stop the physical silver shortage? That's the question posed in our title, and it deserves a thoughtful answer. In theory, higher prices should eventually bring supply and demand back into balance. Higher silver prices would make marginal mines economical again. They would incentivize more aggressive recycling efforts. They would potentially reduce some price-sensitive demand. But this rebalancing process takes time. Mining projects require years to develop. Recycling infrastructure needs investment, and much of the industrial demand is relatively insensitive to price changes. Governments could theoretically intervene by releasing strategic stockpiles, but most governments no longer hold significant silver reserves. The United States sold off most of its government silver stocks decades ago. Exchanges could alter margin requirements or position limits to discourage speculative excess, but such measures don't address fundamental supply-demand imbalances. Ultimately, market forces will determine the outcome, but the path toward equilibrium may involve significant price volatility and persistent physical tightness before new supply comes online or demand destruction occurs. If you already own physical silver, you're facing a set of decisions that require clear thinking rather than emotional reaction. First, understand why you hold silver in the first place. Is it portfolio diversification, insurance against currency debasement, a long-term store of value, speculation on price appreciation? Your core thesis should guide your actions. If nothing fundamental has changed about why you acquired silver, then short-term price movements shouldn't trigger hasty decisions. That said, this is an appropriate time to review your overall asset allocation. Silver, like any asset, should represent a percentage of your total wealth that reflects both its potential benefits and its inherent risks. If silver has appreciated significantly and now represents a disproportionate share of your portfolio, rebalancing might be appropriate. Consider the concept of trimming positions during strength. If premiums are elevated and buyers are eager, selling a portion of your holdings to take some profits off the table isn't abandoning your thesis, it's prudent risk management. You could establish a rule. If silver represents more than a certain percentage of your net worth, sell enough to return to your target allocation. This approach removes emotion from the equation. Storage and security deserve renewed attention. As the value of your holdings increases, so does the importance of proper storage. Home storage has risks. Professional vault storage has costs. Each approach involves trade-offs you should consciously evaluate rather than ignore. Think about liquidity as well. Physical silver is less liquid than stocks or bonds. If you needed to sell quickly, could you do so efficiently? Do you know who would buy your specific products? What the transaction costs would be? These aren't reasons not to hold silver. They're simply realities you should plan for. Also consider the tax implications of selling. In many jurisdictions, precious metals are subject to capital gains taxes. Understanding your tax situation before making transactions prevents unpleasant surprises. Most importantly, avoid the trap of constantly checking prices and reacting to daily fluctuations. Physical precious metals are long-term holdings. Their value lies in what they represent over years and decades, not hours and days. Set a schedule, quarterly or semi-annually, to review your precious metals holdings as part of your broader financial planning. Outside those reviews, resist the temptation to obsess over spot prices. If you don't currently own silver, but you're considering a purchase, you face a different set of considerations. The worst reason to buy silver right now would be fear of missing out. The sense that everyone else is buying and you need to jump in immediately is precisely the emotional state that leads to poor decisions. The best reason to buy silver is as part of a deliberate, thoughtful portfolio strategy. Start by asking yourself what role silver would play in your overall financial picture. Are you looking for portfolio diversification? A hedge against specific economic scenarios? A long-term store of value? Be honest about your risk tolerance. Silver is volatile. It can swing 20 or 30% in a matter of months. If that kind of price movement would cause you to panic and sell at the wrong time, silver may not be appropriate for you. Consider your time horizon. Physical precious metals are not short-term trading vehicles for most people. They're strategic holdings meant to preserve purchasing power over extended periods. If you decide silver fits your strategy, approach the purchase methodically. Don't invest money you might need in the near term. Precious metals should be funded with capital you can afford to leave untouched for years. Research reputable dealers before making your first purchase. Not all dealers are created equal. Look for established companies with transparent pricing, clear buyback policies, and strong customer reviews. Understand the products available. Silver comes in various forms: government-minted coins, private mint rounds, bars of different sizes. Each has different premiums, liquidity characteristics, and recognition in the marketplace. Government coins from recognized mints generally carry higher premiums but offer better liquidity and recognition. Larger bars often have lower premiums per ounce, but can be harder to sell in smaller quantities. For most first-time buyers, well-recognized silver coins like American Silver Eagles, Canadian Maple Leafs, or Austrian Philharmonics represent a reasonable starting point despite higher premiums. Consider dollar-cost averaging rather than trying to time a single large purchase. Buying a fixed dollar amount at regular intervals, monthly or quarterly, reduces the risk of entering at a temporary peak and smooths your average acquisition cost over time. This approach also has the psychological benefit of making silver accumulation a disciplined habit rather than an emotional reaction to market conditions. When you make purchases, verify what you're receiving. Understand the difference between spot price and the total price you're paying, including premiums, shipping, and any other fees. Plan for storage from the beginning. Will you store silver at home, in a safe deposit box, with a professional storage provider? Each option has security implications and costs you should factor into your decision. Don't leverage yourself to buy silver. Using debt to purchase precious metals multiplies your risk without proportionally increasing your potential benefit. If silver prices decline, you're still obligated to repay the borrowed funds. Finally, maintain realistic expectations. Silver is not a path to quick riches. It's a form of financial insurance and a potential store of value. Its primary purpose is preserving what you already have, not exponentially multiplying it. Regardless of whether you're a current holder or prospective buyer, certain principles apply universally. Understand that physical precious metals are part of a comprehensive financial strategy, not the entirety of it. You should also have emergency cash, income-producing assets, skills and knowledge that maintain their value, and relationships that provide mutual support. Stay informed, but be selective about your information sources. The precious metals market attracts both thoughtful analysts and sensationalist promoters. Learn to distinguish between data-driven analysis and emotionally charged marketing. Recognize that market timing is extremely difficult and often counterproductive. Rather than trying to predict whether silver will reach some specific price by some specific date, focus on the fundamental reasons for holding it and whether those reasons remain valid. Accept volatility as inherent to the asset class. Silver will have sharp moves in both directions. These fluctuations don't necessarily indicate that your thesis was wrong. They're simply the nature of the market. Keep your silver strategy private. There's no benefit to advertising what you own. The fewer people who know about your holdings, the better from a security standpoint. Periodically reassess your thesis. Markets evolve, economic conditions change. What made perfect sense 3 years ago might warrant adjustment today. But make these reassessments deliberately and rationally, not in reaction to fear or greed. Let me be direct about the behavioral traps that destroy value and create unnecessary risk in precious metals investing. Physical silver is not a liquid emergency fund. Converting it back to cash takes time and often involves selling at a discount. If you might need the money within the next year or two, it doesn't belong in physical metals. Borrowing money to buy precious metals is one of the most dangerous financial decisions you can make. The carrying costs erode your position. The volatility can trigger margin calls or force liquidation at the worst possible time. And the psychological stress of leveraged positions leads to emotional decision-making. Cash purchases only, no exceptions. Silver had a big move yesterday. That's not a reason to buy. Silver dropped sharply last week. That's not automatically a reason to sell. If you find yourself obsessively checking prices multiple times per day and feeling compelled to take action, you're setting yourself up for poor decisions driven by fear and greed rather than rational analysis. Anyone promising you that silver will definitely reach some specific price is either lying or deluded. Markets don't work that way. The future is inherently uncertain. Be especially wary of promoters offering exclusive opportunities or limited time offers that require you to act immediately. These high-pressure tactics are designed to prevent the careful consideration that protects you from bad decisions. Even if you're bullish on silver's long-term prospects, concentrating your entire net worth in physical metals is excessive risk. Diversification exists for a reason. You need exposure to multiple asset classes to protect against scenarios where your primary thesis doesn't play out as expected. Some dealers will try to sell you rare coins at substantial premiums over their metal content by emphasizing collectible value. Unless you genuinely understand the numismatic market, stick with bullion products valued primarily for their silver content. The collectible premium is speculative and often fails to materialize when you try to sell. Unfortunately, counterfeits exist, especially when buying from unfamiliar sources or through private party transactions. Take steps to verify authenticity. Reputable dealers stand behind their products. Unknown sellers on online marketplaces might not. Every time you buy and sell, you incur transaction costs through dealer spreads and premiums. Excessive trading erodes your capital through these friction costs. Establish your position thoughtfully, then leave it alone unless your circumstances or thesis fundamentally change. When you sell precious metals at a profit, there are typically tax consequences. Failing to report these transactions properly creates legal and financial problems. Understand your jurisdiction's tax treatment of precious metals and comply with reporting requirements. Whether you're storing at home or using professional services, geographic diversification reduces risk. If you have substantial holdings, consider splitting them between multiple secure locations. This protects against localized risks like theft, natural disaster, or other unforeseen events. The physical silver market is revealing structural tensions that have been building for years. Supply is constrained by the economics of mining and the physics of metal extraction. Demand is growing from industrial applications that represent genuine technological requirements, not speculative excess. Inventories that once buffered temporary imbalances are diminishing. Premiums are rising. Delivery times are extending. These are facts, not predictions. What happens next depends on countless variables, from economic policy decisions to technological developments to shifts in investor sentiment. Anyone claiming to know exactly how this plays out is overestimating their certainty. But here's what you can control: your own preparation, your own discipline, your own rational response to unfolding events. If you hold silver, you can ensure it's held for sound reasons and in appropriate quantities. You can resist the emotional extremes of euphoria and panic. You can maintain perspective about its role in your broader financial life. If you're considering silver, you can approach the decision methodically rather than reactively. You can educate yourself about the market, the products, the risks, and the potential benefits. You can develop a plan that reflects your circumstances rather than someone else's agenda. For everyone, regardless of current position, the core principles remain constant. Understand what you own and why you own it. Maintain appropriate diversification across multiple asset classes. Avoid debt and leverage. Think in years and decades, not days and weeks. Stay informed but selective about information sources. Make decisions based on rational analysis rather than fear or greed. The disappearing physical silver supply isn't something that requires panic. It's a market dynamic, unfolding in real time, driven by fundamental forces of supply and demand. Your response to that dynamic should be characterized by the same qualities that define successful long-term investing in any market: patience, discipline, rational analysis, and emotional control. The investors who navigate this environment successfully won't be those who make the most dramatic predictions or take the most extreme positions. They'll be the ones who understand their own financial situation clearly, who position themselves appropriately for their specific circumstances, and who maintain their composure regardless of how volatile the path forward becomes. Silver's role in a portfolio has always been about insurance and preservation rather than speculation and multiplication. That fundamental purpose hasn't changed, even as market conditions evolve. What matters most isn't whether you own silver or how much you own. And what matters is that whatever decisions you make are deliberate, informed, and aligned with your broader financial strategy. The future is uncertain. Markets will continue to surprise us. Unexpected developments will emerge. But you don't need to predict the future to position yourself intelligently for a range of possible outcomes. You need knowledge, discipline, a rational assessment of risk and reward, and the emotional fortitude to stick with sound principles even when markets test your conviction. Those qualities serve you well, whether silver continues tightening, finds equilibrium, or experiences another cycle of boom and bust. They serve you well in precious metals, in traditional markets, and in navigating whatever economic environment emerges over the years and decades ahead. The physical silver market is sending signals. Whether you act on those signals, how you act, and with what portion of your resources, those decisions belong entirely to you. Make them wisely. Make them deliberately. Make them based on your circumstances, not someone else's urgency. And regardless of what you decide, maintain the long-term perspective and emotional discipline that separates successful investors from those who get swept up in every market cycle. The shortage is real. The market dynamics are evolving. Your response should be measured, rational, and appropriate to your individual situation. That approach won't generate exciting headlines, but it will serve your long-term financial well-being far better than any amount of excitement ever could. Stay informed, stay disciplined, stay focused on what actually matters, and trust that sound principles, applied consistently over time, navigate uncertainty better than any attempt to predict or control outcomes that remain ultimately unknowable.